Welcome to the latest in Fitch's series of virtual investor meetings. I'm Kevin Degnan, Global Head of Structured Finance and Covered Bond Ratings. With me today is Kevin Kendra, who heads our U.S. Structured Credit Group. Welcome, Kevin.
Thank you.
Let's start by talking about the credit environment. What sectors or industries are you focusing on and investors focusing on these days when we look at the underlying dynamics in the leveraged loan market?
Sure. So we recently published a piece called U.S. CLOs, Tech on the Radar, highlighting that technology has quietly become the largest sector within U.S. CLOs. That's not to say we're necessarily concerned with technology. Technology is a very broad and diverse sector, so it's a combination of hardware and software, et cetera. Really within the hardware issuers, that's really the area that Fitch has a negative outlook on the underlying sectors, but really those issuers are financed really kind of in a double B rating category. On the software side, that's where we start to see more of the single B rated issuers. But we haven't seen a significant number of software issuers or technology companies in the triple C categories, so it's not our primary concern. Retail is usually highlighted as the next shoe to drop and the next area of concern for CLOs, but really we see that as idiosyncratic risk. You have a lot of headline names like J. Crew that we talked about last year, who really will have their problems, but it's going to be more specific to the business, more specific to the company and how their finances are really working out. So we really see that as more idiosyncratic risk. Earlier this quarter, we wrote a FitchWire Plus piece talking about exposure to the more troubled retail names, and we saw that for the most part, U.S. CLOs will have very minimal impact as a result of that. When we think about systemic risk, one of the areas that we went through is the commodity-related oil and gas sectors. There were a couple of issuers who had concentrated portfolios in oil and gas, and we saw them go through some stress with some failing OC tests and triple C buckets. But by and large, we saw that the portfolio diversification that's inherent with the industry concentration limitations really did protect CLOs, and we saw that even on the energy concentrated structures, we were able to affirm all of our ratings on those notes. So we haven't seen a significant amount of triple C migration of assets into the triple C bucket, and so really we're seeing a good fundamental kind of credit environment, but it's really going to be idiosyncratic risk that we're looking at.
So let's say that credit risk is manageable at this point in the cycle. What other risks are investors inquiring about?
Right. The biggest challenge that CLO managers are dealing with is managing weighted average spread compression in the underlying CLOs. The CLO or the leveraged loan issuance that we've seen year to date really has been dominated with refinancings for the underlying companies. They haven't had a lot of new loans, new credit coming to the market. About 80% of all of the loans have been refinancings. When that spread compression actually comes through into the CLOs, we've seen the 2014 and 2016 vintage CLOs lose about 45 basis points of weighted average spread. That's important for a CLO manager because there's a collateral quality test in there that will the minimum weighted average spread test that they have to manage to. If they actually are bumping up against the minimum weighted average spread test, they're going to have to give up on something else to adjust in managing the CLO. Currently, we have about 20 CLOs that are failing their minimum weighted average spread test. Probably another 140 that are within 10 basis points of their threshold. And in order to do that, they're going to have to either give up and move up on credit quality or move up in diversity or something like that. And we've seen over 90% of the CLOs have had to change that matrix points over the course of the past year.
Okay. Finally, one of the biggest stories of 2017 is probably CLO volume. What are you seeing in terms of the mix of new broadly syndicated loan issuance, resets, refis, and so on, and what's your outlook for the remainder of the year?
Yeah, we think the outlook's going to be very busy for the rest of the year. The first quarter is really dominated by refinancing activity. So we had a period of time where CLOs were able to refinance their liabilities without having to incur risk retention rules. So it's really your 2013 and 2014 vintage CLOs. So we went through a rash of that in the first quarter, not a lot of new issuance. And by our estimates, we've seen about 70% of the CLOs that are eligible to be refinanced without having to incur risk retention have done so. So we do expect to see some refinancing activity throughout the rest of the year, but it won't be the primary driver that we saw earlier. Second quarter's been dominated by new issuance activity. It's really been any manager who's been accumulating portfolios, have access to collateral, then they've been able to actually take advantage of tighter liability spreads that we've seen in the last 3 months. And by doing so, they're issuing new CLOs into the market, and we're seeing a number of new managers, and we're seeing a number of new participants actually stepping into the CLO space. On the reset activity, we expect to see the second half of the year, we expect to see reset activity increase. The advantages of a reset, the managers already have an existing portfolio, so they don't have to source a new portfolio in a market where you have very little new issuance, new credit creation. Second advantage is managers get to issue into a lower spread environment than what we've seen historically. And the last thing is a lot of the managers, in anticipation of the risk retention rules, they've raised a lot of capital to actually comply with the risk retention rules. If they're not able to issue new CLOs, the reset, even though they'll have to become risk retention compliant, it allows them to actually put that risk retention capital that they've raised to work. So that way we think that we're going to see a combination, a little bit of the refinancing, we'll see new issuance to the extent that they can actually acquire new portfolios, and we expect to see some reset activity.
Okay, so it sounds like things will remain dynamic for the remainder of the year. If you have any questions about the topics we discussed today, please contact us at the email on the screen. Thanks for watching.